Question 7. What is the dividend yield of DGRO ETF, and how does it compare to other dividend-focused ETFs? As of February 28, 2024, the dividend yield of DGRO is around 2.5%. This means that the annual dividend distribution per share divided by the current share price translates to roughly a 2.5% yield. Here's how DGRO's dividend yield compares to other popular dividend-focused ETFs. SCHD, Schwab US Dividend Equity ETF, currently has a higher dividend yield, around 3.2%. However, SCHD prioritizes current income over dividend growth, potentially leading to higher volatility. VIG, Vanguard Dividend Growth ETF, currently has a slightly lower dividend yield compared to DGRO, around 2.2%. However, VIG also focuses on dividend growth and might offer similar long-term income potential with potentially lower fees. VOO, Vanguard SP500 ETF, not a dedicated dividend-focused ETF, and its current yield is around 1.5%. While it offers broader market exposure and potential for capital appreciation, its focus isn't on dividend growth. It's important to remember that dividend yield isn't the only factor to consider when choosing a dividend-focused ETF. Other important factors include investment objective. If you prioritize current income, an ETF with a higher yield like SCHD might be appealing. However, if you seek long-term income growth, DGRO or VIG could be better choices due to their focus on dividend-growing companies. Risk tolerance. ETFs with a high focus on high dividend-paying companies, like SCHD, might be more susceptible to economic downturns and have higher volatility. Fees. DGRO generally has lower expense ratios compared to some other options, like VIG and SCHD. Question 8. How frequently does DGRO ETF rebalance its portfolio, and what factors drive these rebalancing decisions? DGRO utilizes a two-pronged approach to portfolio management. 1. Quarterly rebalancing. The DGRO ETF undergoes quarterly rebalancing to ensure the holdings align with the underlying index it tracks. This rebalancing process involves buying or selling shares of companies in the index to maintain their weightings within a certain target range. 2. Annual reconstitution. DGRO also undergoes an annual reconstitution of its underlying index. This process involves reviewing the composition of the index and potentially removing or adding companies based on their eligibility criteria and performance. This ensures the index and, consequently, the DGRO ETF continues to reflect the intended investment strategy of focusing on companies with a history of increasing dividends. Therefore, DGRO uses a combination of quarterly adjustments to maintain alignment with the target weightings and annual reviews to ensure the underlying index accurately reflects its investment objective. Here are some additional points to consider. The specific target weightings for each company within the index are not publicly disclosed. The factors driving the annual reconstitution involve criteria outlined in the index methodology, such as a company's dividend history, financial strength, and market capitalization. While the goal is to maintain a consistent investment strategy, the specific companies within the DGRO ETF might change over time due to the reconstitution process. It's important to remember that rebalancing decisions are based on the underlying index methodology, not on short-term market fluctuations. This approach aims to maintain the long-term investment objective of DGRO, which is to track the performance of companies with a history of increasing dividends. Question 9. How does DGRO's sector allocation compare to the broader market? DGRO, while offering exposure to various sectors, has a distinct sector allocation compared to the broader market, which is typically represented by the SP 500 index. Here's a breakdown of the key differences here. 1. Overweight in consumer staples and utilities here. DGRO, overweight sectors like consumer staples, e.g., food and beverage companies, and utilities, which are known for their consistent dividends and defensive nature. These sectors tend to perform relatively well during economic downturns, potentially providing stability to the overall portfolio. As of February 28, 2024, DGRO allocates around 20% and 15% to these sectors, respectively. SP 500. These sectors have a lower weighting in the SP 500, typically around 10% and 5%, respectively. This reflects the broader market's focus on capturing growth across various industries, not just those prioritizing dividend payouts. 2. Underweight in technology and communication services here. DGRO, underweight sectors like technology and communication services, which, while potentially offering high growth prospects, may have a more volatile dividend history. As of February 28, 2024, DGRO allocates around 10% and 5% to these sectors, respectively. SP 500. These sectors have a higher weighting in the SP 500, typically around 25% and 15%, respectively. This reflects the broader market's exposure to these high-growth sectors, which can significantly impact overall returns. 3. Other sector differences here. Financials. DGRO has a similar weighting in financials compared to the SP 500, typically around 15%. Healthcare. DGRO has a slightly lower weighting in healthcare compared to the SP 500, around 10% versus 15%. Industrials and consumer discretionary. These sectors have similar weightings in both DGRO and the SP 500, typically around 5 to 10% each. It's important to understand these differences and their potential implications here. DGRO's sector allocation prioritizes stability and income over high growth. This can be beneficial for income-seeking investors, or those seeking a more defensive portfolio, but it might underperform the broader market during periods of strong economic growth. The SP 500 offers broader exposure to various sectors, including high-growth sectors, potentially leading to higher returns, but also increased volatility. Question 10. How does DGRO's dividend yield compare to other income-generating investment options? While DGRO offers a decent dividend yield around 2.5% as of February 28, 2024, it's important to compare it to other income-generating options, keeping in mind the associated risks and trade-offs. 1. High-yield bonds. Pros: can offer significantly higher yields, potentially 5 to 8% or more, compared to DGRO, making them attractive for income-focused investors. Cons: carry higher risk due to potential defaults, especially for lower-rated bonds. They are also more sensitive to interest rate fluctuations, meaning their prices can decline if interest rates rise. 2. Real estate investment trusts, REITs. Pros: can offer attractive yields, typically 3 to 5%, and potential for capital appreciation through property value increases. Cons: can be more volatile than DGRO, especially during economic downturns or periods of rising interest rates. They also involve management fees and potential liquidity limitations compared to ETFs. 3. Preferred stocks. Pros: offer fixed dividend payments with priority over common stock in case of liquidation. They can also offer higher yields than common stocks, potentially 4 to 6%. Cons: typically have lower growth potential than common stocks, and can be more volatile due to their fixed income nature. They also lack voting rights compared to common stock. 4. Peer-to-peer lending. Pros: can offer potentially higher returns, ranging from 5% to 10% or more, compared to DGRO, depending on the borrower's creditworthiness. Cons: involve significant risks of borrower defaults and requires careful platform selection and loan diversification. It also may not be as liquid as other options. Question 11. How can options strategies be used to enhance returns or hedge risks associated with DGRO? Options strategies can be complex and involve significant risks, so it's crucial to thoroughly understand these strategies and the potential risks before using them. It's also important to consult with a qualified financial advisor to determine if options strategies are suitable for your investment objectives and risk tolerance. Here's a brief overview of how some options strategies could potentially be used with DGRO, but remember, these are just examples, and using options is not without risks. 1. Covered calls. Goal: generate income and potentially hedge downside risk. Strategy: sell call options on DGRO while holding the underlying shares. This gives the option buyer the right, but not the obligation, to buy the shares from you at a certain price, strike price, by a specific expiry date. If the share price rises above the strike price by expiry, you are obligated to sell your shares at the strike price, potentially limiting your upside gains. However, you keep the premium received from selling the call option, which generates income. If the share price stays below the strike price by expiry, the call option expires worthless, and you keep your DGRO shares. 2. Cash-secured puts. Goal: generate income and potentially acquire DGRO shares at a lower price. Strategy: sell put options on DGRO, while having enough cash readily available to cover the potential obligation to buy shares at the strike price if the option is exercised. If the share price stays above the strike price by expiry, the put option expires worthless, and you keep the premium received from selling the put option. However, if the share price falls below the strike price by expiry, the option buyer exercises their right to sell you shares at the strike price. This could be beneficial if you believe the share price might decline, but are also interested in acquiring DGRO shares at a lower price. Important points to remember. Options strategies involve significant risks. Using options can lead to substantial losses if not used correctly. It's crucial to understand the risks involved before using any options strategies. Not suitable for all investors. Options strategies are generally complex and can be risky. They are not suitable for all investors, especially those with a low risk tolerance or limited investment experience. Question 12. How does DGRO fit within a broader portfolio allocation strategy, particularly for institutional investors? For institutional investors like pension funds, endowments, or insurance companies, DGRO can potentially play a role within a broader portfolio allocation strategy, but it's crucial to consider its specific characteristics and how they align with their investment objectives. Here's a breakdown of how DGRO might fit into such a strategy. Potential benefits. Diversification. DGRO offers exposure to a variety of U.S. companies across various sectors, contributing to overall portfolio diversification. This can help mitigate risk and potentially improve risk-adjusted returns. Income generation. DGRO's focus on companies with a history of increasing dividends can provide a reliable stream of income, which can be crucial for institutions with specific income requirements, such as meeting pension payout obligations. Long-term growth potential. While DGRO prioritizes dividend growth, the underlying companies also have the potential to appreciate in value over time, offering capital appreciation alongside the income stream. Low fees. DGRO typically has lower expense ratios compared to some actively managed funds, which can be beneficial for institutional investors managing large portfolios. Considerations for institutional investors. Investment horizon. DGRO is generally suitable for long-term investors due to its focus on dividend growth and potential for capital appreciation over time. Institutional investors with shorter investment horizons might need to consider other options. Risk tolerance. While DGRO offers diversification, it's still exposed to market fluctuations and other risks. Institutional investors with a lower risk tolerance might need to allocate a smaller portion of their portfolio to DGRO or consider alternative assets with lower risk profiles. Alternative investment options. Institutional investors have access to a wider range of investment options compared to individual investors. They might consider alternative income-generating assets like real estate investment trusts, REITs, or high-yield bonds, depending on their specific risk tolerance and income needs. Portfolio allocation strategy. DGRO should be integrated within a broader portfolio allocation strategy that considers the institution's overall risk tolerance, investment objectives, and liability requirements. Alright, everyone, that wraps up our comprehensive look at the DGRO ETF. Remember, DGRO can be a valuable tool for investors seeking income and long-term growth, but it's crucial to consider your individual circumstances and risk tolerance before investing. Key takeaways. DGRO offers exposure to dividend-growing companies, potentially providing consistent income and capital appreciation over time. It boasts diversification across various sectors, but has a higher weighting in consumer staples and utilities compared to the broader market. While DGRO offers a decent dividend yield, there are alternative income-generating options like REITs and high-yield bonds, each with its own risks and rewards. Option strategies can be used with DGRO, but they involve significant risks and are not suitable for all investors. For institutional investors, DGRO can be a part of a broader portfolio allocation strategy, but careful consideration of their investment objectives and risk tolerance is crucial. If you're interested in learning more about DGRO or other dividend-focused ETFs, be sure to check out the resources listed in the video description below. We also encourage you to consult with a qualified financial advisor to discuss your specific investment goals and risk tolerance before making any investment decisions. Thanks for joining us today on Chat ETF. Don't forget to like this video, subscribe to the channel for more informative content on ETFs, and hit the notification bell so you never miss an upload. Until next time, happy investing.